Coherent just delivered a clean beat and raise with EPS up 74% year over year, but operating cash flow collapsed from $634 million to just $79 million. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Coherent gets graded and traded. Alright, on the top line, revenue came in about 3% above what analysts expected. That's a solid beat, but the real story here is that revenue grew almost 34% year over year, driven almost entirely by AI data center demand. On the earnings side, they beat by about 10%, coming in at $1.74 per share. EPS is what Wall Street grades a company on, and a double-digit beat like this gets Wall Street's attention right away. So on the beat itself, this earns a B. A 3% revenue beat and a 10% EPS beat is a solid combination, just not a blowout. And on consistency, this earns an A. They've been reliably topping estimates quarter after quarter, and this print keeps that streak going. Let's talk about the positives from the report. Revenue for the quarter came in at just over $2 billion, which is a 34% jump from a year ago. That kind of growth is huge, and it tells you the AI data center demand story is showing up in the actual numbers now, not just the narrative. Their gross margin jumped by about 2 percentage points to just over 40%. That means for every dollar of revenue they bring in, they're keeping more of it as profit than they were a year ago. This is the difference between a business just getting bigger and a business getting genuinely better. Now this is the one I actually care about. Their data center business, which sells the optical connections that link AI chips together, hit $1.62 billion this quarter, up almost 60% year over year. And here's the kicker. It's now 79% of the entire company. This is no longer a diversified photonics business. It's an AI infrastructure play. Management raised their forecast for next quarter. They're guiding revenue to a range of $2.2 to $2.4 billion, and EPS to a range of $1.85 to $2.05. That EPS range sits above the $1.74 they just delivered, which tells you they don't see any slowdown coming. And their cash position more than doubled to about $2 billion, while long-term debt came down. They raised money by issuing new shares, and they used it to strengthen the balance sheet. That gives them room to keep investing without financial pressure. So on profitability, this earns an A. Margins expanded across the board, EPS grew at more than twice the rate of revenue, and the balance sheet is in the best shape it's been in years. Now, let's talk about the negatives from the report. Their industrial segment, which is the non-AI half of the business, keeps shrinking. Revenue there fell almost 16% year over year to about $430 million. So while the AI side is exploding, the traditional side is still going backwards, and that's a drag on the overall story. Here's the one I keep coming back to. Operating cash flow for the full year collapsed to just $79 million, down from $634 million the year before. That's a massive drop. It means the profits you see on paper aren't turning into actual cash hitting the bank, because they're spending heavily to build out capacity for the AI ramp. And their inventory ballooned almost 80% year over year to $2.58 billion. Inventory is product sitting on the shelf waiting to be sold. If AI demand cools off even a little, they're going to be stuck holding a lot of expensive product they can't move, which would hit their financials hard. On top of the cash issues, their diluted share count jumped 30% year over year. That's because they issued about $2 billion of new stock to raise cash. Every existing shareholder now owns a smaller slice of the company. So even though total earnings are growing, each share is worth a little less of that growth. And the gap between their reported earnings and their adjusted earnings is still huge. The clean number they're showing everyone is $5.61 for the full year, but the actual reported number is only $4.12. That $421 million gap comes from restructuring costs, write-downs, and other adjustments that keep showing up quarter after quarter. On guidance, this earns an A. They stepped up next quarter's revenue and EPS ranges, both above what they just delivered. That's management telling you loud and clear they see the demand ramp continuing. And on red flags, I'm at a C. The cash flow collapse, the inventory build, and the share dilution are all real concerns. The story is still intact, but this is a company making a massive bet, and if AI demand pauses even briefly, the working capital exposure gets ugly fast. Putting it all together, this is a genuine beat and raise print that validates the AI optical thesis in a way we hadn't seen before. Data center revenue is now 79% of the business and growing almost 60% year over year, and management raised guidance on top of it. But the cash flow statement tells a different story than the income statement. They're spending heavily and building inventory to fund the ramp, and any pause in AI demand would leave a lot of exposed working capital. Overall, I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. The beat and raise looks clean, but chasing this rally right after the print is where I get hurt. I'd rather sit and let the excitement fade first. My favorite move here is selling cash-secured puts about 10 to 15% below where the stock lands post-earnings. That way I get paid premium while I wait for a better entry. If I'm buying shares outright, I'm scaling in a piece at a time. Taking a full position into the initial pop leaves me exposed to the negative free cash flow and inventory build the market hasn't digested yet. That's why I'm waiting for the pullback before I commit real size. The volatility crush after this print combined with the raised guidance gives me a really nice setup for selling cash-secured puts. Premium's still juicy, and the fundamental backdrop just got stronger. I'm looking at 30 to 45 days to expiration, and I want my strikes below the pre-earnings base, not above it. If the stock mean reverts, I don't want to get assigned at some inflated post-pop level. My strike floor is a price I actually want to own the stock at, given the industrial segment weakness and the cash flow profile. My ceiling is anywhere I'd happily take assignment on a name-growing data center revenue, 58% year over year. So I'm selling puts below the base, not chasing strikes near the pop. I'm holding my shares. The next quarter's revenue guidance of $2.2 to $2.4 billion and EPS of 1.85 to 2.05 extends my thesis by another quarter cleanly. Data center and communications is now 79% of revenue, which confirms the AI optical mix shift I bought this story for in the first place. That's exactly what I wanted to see. The only time I'd trim is if the stock gaps up more than 20% into pure euphoria with no pullback at all. The working capital risk deserves some respect on position sizing, but short of that, I let the trade run. For now, I'm holding and letting it run. If I've got covered calls on and the stock just popped, the raised guidance for next quarter tells me I don't want to let my shares get called away at those old pre-earnings strikes. The EPS guidance of 1.85 to 2.05 implies there's meaningful upside room from wherever the stock opens after this print. Getting assigned right now would leave money on the table. So if my existing calls are deep in the money after the pop, I'm rolling them 10 to 15% higher and out to 60 or 90 days. That keeps my upside alive and still collects some incremental premium. That's why I'm rolling my calls up and out. This print is exactly the segment validation I was hoping for as a LEAPS holder. The AI optical thesis just got confirmed in the numbers, not just the narrative. Data center and communications came in at $5.27 billion for the full year, up 40% year over year. That's the growth engine my long-dated calls were betting on. My 12 to 24 month thesis is stronger today than it was 3 months ago. The only reason I'd take profits on any leap is if one specific position got oversized relative to my portfolio risk after this pop. Otherwise, I'm holding and adding on dips. This release validates the original bull case for me. Data center growth accelerated. Margins expanded more than 2 percentage points. And that's the kind of print that makes averaging down defensible. Forward guidance actually stepped up instead of flattening out, which is what I needed to see before adding to a losing position. The segment mix confirmation is real. That said, I'm sizing my adds carefully because free cash flow is still negative. This company is reinvesting aggressively, and the ride stays volatile even with the thesis intact. I'm adding on consolidation, not chasing the pop. So for me, averaging down here is defensible. Bottom line, this print earns a B+ from me. The AI optical thesis is now real in the segment numbers, not just narrative, and the raised guide extends the runway another quarter. Just don't lose sight of the cash flow and inventory risks that come with a bet this big. Thanks for watching, and I'll see you on the next one.